Okay, so let's go to our new topic. Before we go to exchange traded markets versus OTC markets, we have to ensure that I have to discuss another topic before that topic that precedes this, because we'll be discussing this topic in that. So let's look at your notes. Everything is pasted into your notes already. Okay, this is the topic that we need to cover. Okay, so now, as we said, the options module is over. Okay, the options module is over. We had that discussion yesterday as well on market makers. So now option market making, end of options module. We are moving back into the financial markets module. We covered a little bit yesterday, and we did a lot of revision on trading. So there were a lot of questions on the trading system, very good questions actually, on trading system calculation, so which we dealt with. So today we are coming back into the introduction to financial markets module. Okay, so you should also understand that the reason the course is being taught like this, obviously because we are constrained by the projects that we have to do. So ideally, the way I would structure the material is, first I would teach you all the introduction to financial markets, which itself is a huge module. Okay, because we have to cover capital markets, we have to cover all kinds of stuff. Okay, which we have OTC versus exchange traded. We haven't even covered this. This is actually a basic topic. As you can see, even in the Hull book, it appears in the first chapter. Okay, so but anyway, so we have not been able to cover it because in every case, every course we have a project, and so immediately the pressure is on me to give you the basic the bare essential knowledge base to be able to execute the project in a sensible way. So therefore I have to break my flow of the introductory material coverage and move into project specific material, okay, which we also had to do in the case of options. But since we did options, we have covered pretty much all of the basic option topics. Okay, so now again, what we are going back to, that's why this kind of material. So you might wonder, why is this material covered like this? First we do some initial basics on trading, on quotes, bids and offers, market makers, this, that, then again we move into options. Now we're going back into OTC markets, etc. Normally you would not be going into options coverage before looking at a topic like OTC versus exchange traded markets. That's a much more basic topic. But the reason we have to do it like this is because we are constrained by the projects and the necessity to cover the material that helps you to do the project. Is that clear? So everyone should understand why we are proceeding in the manner in which we are proceeding, right? Okay, so the first topic we need now, that's why I talked about the sequencing of topics. Sequencing of topics is one of the main reasons I don't use textbooks is I'm not at all satisfied about the sequencing of topics. So actually, when you discuss OTC markets versus exchange traded markets, it helps to understand different types of risk, okay, because you'll see that distinction coming out in the OTC versus ETM. So therefore we have to first talk about a preceding topic, which is like a prerequisite. A preceding topic is a taxonomy of risks. Actually, maybe we should talk about, this should be a plural, a taxonomy of risks, because there are different types of risks. So if we do a taxonomy of students on this campus, it would be a taxonomy of students, which is plural. Okay, right. So the main two risks that we have to, so these are the risks, you can read them here. Okay, is the font big enough, Srishti? Backbench? Okay, yeah. All right. Okay. So yeah. So who else wanted to go out? Whoever wants to go out, just one person at a time. Kanika, keep watch that only one person goes out at a time. Okay. All right. So you guys can read the 5 types of risk. Okay. Some people sometimes talk about liquidity risk as a separate type of risk, but I have not put it as a separate category of risk, because I think liquidity risk really basically ends up manifesting as market risk. Okay, and so basically, what is market risk? Market risk, you guys are already familiar with market risk. It's you have already seen it yourself. You buy an option, okay, and then the option price starts falling. Okay, or you buy an underlying asset, you buy a stock, and the stock price falls. So when we are talking about risk, we are talking about a risk in a one-sided perspective on risk, which is only from the loss side. We are not considering profit as risk, because profit is also uncertain, but we don't consider profit as a risk. That's the way I approach it. Okay, in classical finance theory, the perspective is actually more balanced. So they use standard deviation as a measure of risk, which means whether it's upside or downside, it's still considered as risk. Okay, so here, like if I look at, so here again, so I've just gone long here on dollar yen. So this, I have put a stop over here actually, and then I have some other buy orders in here. Now I'm not concerned about, now I'm also not certain about the upside. It may go to 110, it may go to 111, it may go to 112. So that is also uncertain, but I don't consider that as a risk, because in all those scenarios I'm making money. I'm not really concerned with that. So I use a more layman's perspective on it. So you should be aware of both the perspectives. In classical finance, they talk about risk as if it's uncertainty. Now uncertainty applies on both sides. Yeah, because even your profits are uncertain. Okay, so but the perspective that I'm adopting is that we are defining risk only as a downside risk, the risk of losses. Okay, so we are not departing from the classical finance view, because I don't think that view is very useful. Okay, so when you're looking at standard deviation as a measure of risk, you understand standard deviation is both sides, above and below the mean, both sides, right? So standard deviation as a measure of risk, when it's being used in classical finance, you have to understand that the implicit definition, the implicit understanding of risk is that both types of uncertainty are considered as risk. That's why they are using standard deviation as a measure of risk. Is this clear to everyone? So you'll see that everywhere in classical finance we use standard deviation as a measure of risk, and as you know, standard deviation covers deviations on both sides. So essentially, when you're using that as a measure of risk, that means your view is that here both sides are part of my risk. Okay, you could say it's a matter of nomenclature. So what difference does it matter? What difference does it make what you call it? You could say that also, but I think it's useful to have clear definitions. And in terms of risk, when we talk about it, will make a difference sometimes for your clarity. So is this point clear? Yes. Okay, that we are going to discuss risk from a one-sided perspective. That for us, risk only means the risk of loss. Okay, profit uncertainty, we aren't really concerned whether I make $150 or I make $135. I'm not really concerned about that, because when I'm entering the trade, my main concern is basically, because that's not eating into my risk capital. Whether I make 135 or I make 150 or I make 165, that's not going to eat into my risk capital. What will eat into my risk capital is when I make a loss. Is this clear? Okay, so it's a different perspective. So you should be aware of these two different perspectives, and you should be aware that the use of standard deviation to measure risk implicitly suggests that the perception is that both sides of the coin, both types of uncertainty are considered equally bad. That's what it is, right? But in fact, obviously, it's not equally bad, right? We are mainly concerned only with risk protection, because as you can see here, I have only placed a stop, but I have not placed a take profit, because I don't use take profit, because I'm not really concerned with, as long as and because I don't believe in the targeted method. I prefer the trailing stop method. So targeted take profit. So therefore, both sides are not equal. Okay, so that's the first point to get out of the way as far as risk is concerned. All right. So the first point is clear. These are all happening in your notes, so everything is written down. So we are now, so these are the 5 types of risks that we have talked about. Now, I'm not going to discuss all the 5 types in detail, because for the purposes are, because we don't have time. So the purposes are, we will revisit this if we do the case on corporate treasury risk management later. Okay, but the most important two most important types of risk are what we are going to cover. Okay, so market risk and credit risk. Market risk, as you can see here, basically you've already seen it yourself. You buy the shares of TCS, and then the share price drops. So that's your market risk. Okay, so you bought it, maybe you invested $10 million to buy it, but now the value of those stock holdings is only $9 million. So you're showing a mark-to-market loss of $1 million. So this, when you bought it, the possibility that you could have lost money on it because of the share price moving down, that's what we call market risk. Okay, where basically assets which are being actively traded in markets, okay, which, what have I written here, as prices of assets fall, prices of liabilities rise. Okay, that is, if you have a loan in yen, let's say an Indian company has a loan in yen, okay, that let's say has a certain rupee value at a point of time when you take the loan. Okay, so when you take a loan in yen, and let's say we take, since we are talking about dollar yen, let's talk about a US company. Okay, so let's say Procter & Gamble has a loan has taken a loan in yen. Okay, Procter & Gamble maybe is not a good example because they have revenues in yen, but let's look at some other company, let's say which let's say Intel doesn't have, let's assume that some company, let's say maybe Chesapeake Energy has no revenues in yen, and they have taken a loan in yen. Okay, so their financials are in US dollars. Okay, so their liability is a yen liability. Okay, you will see this later on, obviously, in the case as well. But they have a yen liability, and that the yen liability has a certain dollar value, because their financials are in dollars. You can't show a yen amount on their balance sheet. You can't write a yen amount on their balance sheet. You have to write a dollar amount, right? It may be a yen loan, but you have to write the dollar equivalent value of that loan when you are making their balance sheet, right? So how will you come out with a dollar equivalent value? You will take this current rate. If you're making the balance sheet now, you'll take, let's say it's a 5 billion yen liability, then you'll divide that 5 billion yen by this 109.27. That is the market rate at this time when you're making the balance sheet. That gives you a dollar value, right? And that's your dollar value. That's what you're going to put on the balance sheet. That is the dollar value of the yen loan. Why liabilities rise? Now what happens is, if the yen strengthens dramatically, if the yen strengthens, let's say to 104, okay, let's say at the end of the next quarter the yen strengthens to 104. Now what is happening? See, the yen loan amount has not changed. The yen loan amount is still 5 billion yen. Okay, but now what has happened is you're dividing 5 billion by, earlier you divided 5 billion by 109.27. Now you're dividing 5 billion by 104. So the dollar value will be higher now when you divide by 104. Is this clear? Right? So what has happened? Because of the exchange rate movement, the dollar value of their yen liabilities has gone up. Yen amount is fixed, but they don't have revenues in yen, so they are going to take their dollar revenues and buy yen in the foreign exchange markets and repay that yen loan, right? So they are concerned with this. So here's another example of market risk, not necessarily on the asset side. That's why I've written this as prices of assets fall. So I've given a balance sheet based definition. Prices of any asset you own, if the value of the asset drops, okay, that's also market risk. Okay, and here prices of liabilities rise, value of liabilities rises, that is also bad for you. Is this clear? Can you see now?
Yes.
Liability value rising means, okay, that this is also bad for you. Okay, so let's look at what have we written here. If we can improve the definition, prices of assets fall, prices of liabilities rise. We can write this a little bit better. We can, yeah, it's okay. We can write it as prices, because what is happening in this situation, please make sure everybody understands. Normally we would call it we would say normally that the value of the liability has gone up. I use the expression dollar value of the liability has gone up. Okay, but you can also call it the dollar price. That 5 billion yen now has to be bought in the market with dollars, and your each dollar is worth only 104 yen right now. So the dollar price of that 5 billion yen has gone up. So this definition is okay. All right. Although in layman's terms, when we have the discussion, we say the value of the dollar value of the liability has gone up, but actually it's the price. You can also say it's the price. Is this clear? Am I making sense? Anytime you don't understand?
It should be price only. It cannot be value.
Yeah, but when we say when we talk about the balance sheet, sometimes we say yeah, you're right. It is not value because it's not subjective. You're right about that. Okay. So, but again, when we normally have discourse, if you see, when we talk about the balance sheet, sometimes we say the dollar value of my liabilities has gone up. We use these expressions. You're right that it's the correct. If we want to always maintain a distinction between price and value, we should use the word price, because in this case it's objective. There's nothing uncertain about it. When the dollar yen drops to 104, the dollar price of your yen liability is now much higher, right? Okay. All right, so we have understood this. Now you have understood market risk, very easy to understand. So we basically only talk about yeah, so I have defined liquidity risk as basically like in the 2007 credit crisis, a lot of the mortgage-backed securities people were holding, they basically dropped in price because of lack of liquidity. Okay, lack of enough players in the market. Okay, so I have merged liquidity risk into market risk, because I'm saying that liquidity risk basically essentially manifests itself quickly as market risk. If you're in a market where it's illiquid, okay, maybe you're trying to sell a house in Port Blair in the Andaman Islands, maybe there's not enough liquidity, nobody really wants to stay there. So if you want to sell it, you'll have to basically deeply discount the price, and if you really give it a bargain basement price, some guy will come in and buy, well, it's a great deal at this price, and then he'll buy it. That's what happens in the case of liquidity risk. Okay, so so therefore I've merged it into this. Now credit risk, so market risk, everyone's clear now? Okay, credit risk is basically a borrower defaulting, trade counterparty walking away from deal. any such situation. Like, you know, that recently you had all these any kind of situation. It need not be an official bankruptcy filing, okay, although nowadays it's very easy under our new bankruptcy law to get that filing for one default itself. But any kind of situation where there are financial difficulties and some loan doesn't get paid, or some commercial supplier doesn't get paid, some guy who has supplied chairs maybe to some you know, during a conference room construction in ILFS, and ILFS got into financial difficulties, they are not able to pay, okay. So any time you have a commercial transaction with somebody and the other guy on the other side of the contract fails to pay, okay, it may be due to unwillingness to pay. So when we are talking about failure to pay, it could usually be due to either ability to pay and willingness to pay. Okay, so sometimes, you know, you have this term in India called willful defaulter. Like some of the banks were trying to label Vijay Mallya as a willful defaulter. Okay, and for instance, I remember once in Calcutta High Court they shot it down. They shot down that label. But anyway, so the willful defaulter concept brings out this concept of willingness to pay versus maybe we can bring it. I can just write it briefly here, although it's so. Default, okay, I'm not going to write equal to ability stroke willingness to pay. So I may have money like Vijay Mallya, but I don't want to pay, okay. So you could have a default. So this default could be driven by unwillingness to pay. Okay, it could relate to the willingness to pay or lack of it, or it could also relate to ability, like you're genuinely out of funds, like Lehman Brothers. Basically, eventually they were not in a position to pay. The question of willingness did not arise. They didn't have the money to pay. Okay, so because nobody was willing to deposit with them, etc. So it could be either. All right. So that's why when you have this term like a willful defaulter, it brings out the difference between the ability to pay and the willingness to pay. All right. So credit risk is also fairly clear now, that if you have any transaction, any kind of contract with anybody, that's why I've written it as trade counterparty walks away from deal. You're basically one party is, if you want to write this in terms of contract law, then you write it as basically one party is not willing to honor its obligation under the contract. Credit risk, if I give a furniture order, if I go to a furniture shop and ask him to design some furniture for my living room, he comes and delivers everything, let's say all on credit, no advance payment. He comes and delivers all the furniture, sets it all up in my room, and now I tell him, get lost, I'm not going to pay you. Okay, so he can sue me, but the point is right now he has a problem. Obviously litigation is always expensive and time consuming, so he does have a credit risk problem right now because one of his customers is not willing to pay. Okay, so any kind of situation like that, that's credit risk. Okay, so is this clear? We've got these two definitions out of the way, right? So now we are going, so I'm not going to cover the other types, but since I did a text, since I was talking about these two risks, you can just read about this on your own, and we can, so I just wanted to make sure that we understand market risk and credit risk, the distinction between these two. Okay, so sometimes you can also have there is a connection between the two as well, which is like, for instance, if you see all the people who had contracts outstanding with Lehman Brothers, when they had all the people who had contracts outstanding with Lehman Brothers when they defaulted, okay, those people were actually facing credit risk. Okay, but their credit risk is actually arising mainly because of the market risk. It's driven by market risks, a little bit by lack of liquidity in that, because when the market panic set in, and when liquidity is also not a constant thing. When these mortgage-backed securities were trading very well in 2006, 2007, to the early part of 2007, the trouble started in June of 2007 actually. Okay, but up until then everything was hunky-dory, right? Everybody was trading actively, so everything is fine. So market sentiment can just turn on a dime. That also you should be aware of, right? Market sentiment pretty much in any market can just turn on a dime. Here what happened is the market sentiment quickly turned, very quickly it turned. So up until then everything was fine. Everything was liquid, people were willing to trade. It's like musical chairs. When people feel that the music is about to stop, then things get a little panicky. Okay, so so that's when the market gets panicky, people don't want to trade, and that's when you see the manifestation of lack of liquidity, and that's when you have to sell at what we call fire sale prices. Okay, is this clear? Okay, so it's all connected really. So but now we understand market risk versus credit risk. Okay, so let's go on to, we are not going to take anything, what is it, Yeah, so we say the other term that we say that the risk has materialized when you take a position and then you have this phenomenon of people losing money on the position, or credit risk when the other guy actually tells you, when you actually come to know that this Lehman Brothers is not going to be honoring its contract. When you come to know, we say that the credit risk is always there. Even when I'm dealing with a company like ITC or Hindustan Lever, who are very liquid, cash-rich companies, theoretically the credit risk is always there, because they may decide that we are not going to pay you. Okay, it's about willingness to pay. It might become like willingness to pay. But when it actually, so the credit risk is always there, but when it actually happens that you come to know that Lehman Brothers has filed for bankruptcy and they're not going to be honoring their contracts in the normal way, that's when we say that the risk has materialized. Okay, the risk is always present, but now it has materialized. Okay, or crystallized, or materialized is a better word. Okay, so that's our next topic. Okay, over the counter versus exchange traded. I think we need one more. One sec. Actually, keep this, because actually so many other pages don't open here, so I come prepared. I open all kinds of pages in my office and come here because I don't want to get stuck not being able to open a page here. Okay, what was I saying? Yeah, I need to open this asset classes, markets and instruments. Okay, so we're going to learn about this distinction about between these two types of markets. So this, what you should also do is you should read this. This is covered in, I've given you the chapter notes, the chapter references. So if we go here, we do chapter 1. Okay, here itself you can read it. The reason I'm not teaching you from there is because I think it's not very well explained, because straight away he has talked about OTC markets and central counterparty and all that, which actually is a newer development. So we need to talk about, to understand the difference between two topics, two different entities, we have to talk about the classical distinction as it has existed for several years, okay, hundreds of years, and then we talk about the new developments. Otherwise you don't understand the real difference. Okay, so you should do this reading. Okay, so this 1.1, obviously you can read the part before that also, exchange traded and OTC markets. You can see this here. So this is included in your coverage. Okay, so you should read this, but it's just basically talking about what is what, and you should also know what kind of, in India also you should know what kind of exchanges exist. Okay, at least you read the Indian part of the book in your textbook. Okay, remember to do that. All the textbooks, you have two textbooks so far, and both of them. Wait, the doorkeeper herself has gone out. Okay, so now in the Indian, remember that in your two books, okay, there's always that Indian market segment which you should read. Okay, that's your responsibility. It's just giving you some information. It's not really anything, there's no concept involved. If you get stuck with some concept, then you can ask me and then I can explain it. Okay, that's your responsibility to read, because you need to know, you need to have that kind of information also. All right. Okay, so this, yeah.
So in last class you said that the system and score calculation will come, you have to revise it. So
You should know what is the, once you understand what system edge is, you should never forget it in your life.
yes.
You should know what it is. You should know it as, you should remember it in your mind. See how the information should be organized in your mind is like this. That's how you organize information in a modular way, which is, you should remember, the only thing you need to remember is that the system edge is nothing but the mathematical expectation of the system. Okay, now the question arises, what is mathematical expectation? Then you should call another definition. 1 minute, let me finish, let me just so then you should call, in your mind you should call like a program calls, your mind should be working like a program. You should call mathematical expectation, that is summation pi xi. Okay, and so you should also remember that mathematical expectation is also not a new concept, it's a weighted average. It's simply a weighted average, which is a much more basic concept which you have learned in early school years. Weighted average, all that you're doing is you're using the probabilities as the weights. That's all. Mathematical expectation is not really a new concept. It's just the application of weighted average, It's just that you're using the probabilities as the weights. If you remember it this way, then it's much harder to forget, and the concepts basically are solidified. Okay, so now it's a mathematical expectation of your system, and if you're doing an ex-ante system edge, then those probabilities are based, those are ex-ante probabilities where it's not historical frequency. Yeah, what is your question?
So then how that will be applied in options? Because while doing position signing for options, you said that we would consider the exit price and the premium is launched.
Okay. No, so in the case when you can't estimate the exit price, you can. There's nothing stopping you, like in the sense that, see, suppose in the case of options, let's take the crude oil again. Let's take the crude oil options because that is active. See, you can always take a view. It may not happen. See, remember I gave you yesterday, we were talking about trading in dollar Swiss, okay, or even if I'm talking about trading in dollar yen, okay. Now there's no difference really between trading in dollar yen and trading in crude oil options or Microsoft options. Why? Because when let's say I'm saying that I've gone long here at 109.30, okay, and I have put a stop here, let's say at 108.60 or something. If you see this closer, it's somewhere like 108.60 or something. I've gone long at 109.30, I put a stop at 108.60, okay. This takes care of my maximum loss part, average risk per trade. I look at the average risk per trade and I put my maximum loss. Now, I would like, my view is, let's say my view is that this thing is going to 114. Let's say that's my view, okay. So I would put, let's say if I were using targeted take profit, but I would actually again have to go through the system calculations to come up with that, okay. But whatever, suppose I say my system calculation tells me that because of the R3 I need to have, my take profit here should be at 114. So I put it there. Now, there's no guarantee that it will go to 114. It's the same with, you can just replace this dollar yen chart with the chart of an option. Except that in the case of an option, we are saying that we don't need to put a stop because your maximum risk is the premium, and we assume that the option is held to maturity and it will go for it will expire worthless. Okay. So suppose you have spent $2,000 on the premium, okay, and suppose your R3 is 10. Then you have to wait.
We are spending $2,000 on premium. We are spending like $2 and $3 for buying one option.
No, I'm saying you may buy several contracts. No, you may buy several contracts. See, 1 minute, 1 sec. 1 minute. One sec. Let's get this $2,000. Let's also average time step. Now, US equity options, the contract size is 100. So when you see an option price, let's say if it shows $2, okay. So actually, when you buy even one contract of that option, okay, because these are exchange traded products, these are exchange traded products. So as you will see later, you will have to trade in contracts, and you can't say I want to buy 1.5 contracts. Okay, you have to buy in integer multiples of contracts. Okay, so the price of the option is shown as $2. Okay, you buy one contract, you are actually paying $200. Because contract size is $100, because even your underlying, it matches the underlying. If you see the in options also, 1 minute.
When you say increase the lot.
See, Amazon, if you want to buy Amazon, if you want to trade in market lots when the market is open, if you are trading in Oracle shares, this price of Oracle shares $55.98, this is price per share. But when you do one market lot, and in this price is for a market lot. So when you buy Oracle, if you buy one lot of Oracle, you can't buy like 17 shares. You have to buy 100 shares because that's the market lot. Okay, so that's 55. The money you have to put up is 55.98 into 100. Right? Similarly, when you look at option prices on Oracle or any other whatever, okay, if the option price is showing, let's say 889, let's assume this is the price of an option. If the price of the option is shown as 889, let's assume, okay, if the price of the option is shown as 889, then if you buy one contract, one option contract, right, you are actually going to pay 8.89 into 100. That's your outlay for one contract, right? Is this clear? So contract size should always be kept sight of wherever there is a contract size applicable. Sometimes in OTC markets, that's one of the advantages. In OTC markets, you don't have to have contract size. I can come and go to a dealer and say I want to buy 673,219 Swiss francs. That's okay in OTC markets, okay? So I don't need to worry about contract size. Contract size concern only comes up in exchange traded markets where everything is standardized. Pretty much everything is standardized, okay? So therefore you have to, is this point clear? That $2,000, yeah, if you have, let's say, the price of the option is 2 and you are buying, let's say, 10 contracts, then you're already buying 2,000, you're spending $2,000. Is this clear to everyone? Yes, Sukriti, are you following? $2 option price, each contract is for 100 shares. So if you bought one contract, you would have to pay $200. You are buying 10 contracts, so nothing stops you from buying 10 contracts, integer multiples, so you're spending 2,000. In this case, we assume that your maximum dollar risk per trade in your system calculations has come out to 2,000, and you are buying the $2,000. You are spending $2,000 to buy the options, and we are going to treat it as full amount. We are assuming. In practice, obviously, in this kind of a situation, your actual losses will always be will tend to be less, because some of the options you may just square out before expiration. We just make that assumptions for risk. We make that assumption for risk planning because it gives us much more clarity. Right? Are you following what I'm saying? For the sake of risk planning, we assume, and position sizing and risk planning, we assume that the entire option premium will be wasted and it will be held to expiry and it will expire worthless. So the entire $2,000 I spent in buying 10 contracts, all of them will expire worthless. I'll hold it to expiration and I'll lose $2,000. That's for your risk planning, because risk planning, if it is too conservative, that's never going to hurt you in life. If you're risk planning, so if you look at the whole risk management, the way I have taught you risk management, it is an ultra conservative approach to risk management, and that's never going to be a problem. In practice, what you can do always is that even though you assume that that is for your risk planning, to be more conservative, you plan to lose $6 million. In practice, you lose $3.5 million. Not a problem, because you're already ready to lose 6 million, right? If you plan to lose 6 million and you lose 13 million, then it's a problem. Right? So in this case, what you would actually do is, in practice, even though for risk planning you assume that the option expires worthless, then the entire premium is lost. In practice, if your view changes halfway through, you would just sell off the option in the market and you will get some recovery. Are you following what I'm saying? In practice, when you're trading in practice, if your view changes, then obviously you should not any longer hold the option. You should sell it off and you will get some revenue from selling it off. Is everyone following? Okay. So in practice, what will happen is your actual losses will be less, because I presume that all the options will not expire worthless. You will be able to sell off some before maturity because your view has turned. Is this clear? So your actual losses will always be worse, will tend to be less than the worst case scenario, or let's say they could well be less than the worst case scenario, which is maximum loss on all options bought. This is clear? Is everyone following? Yeah. So coming back, let's answer Tanya's question first. Yeah.
Another question is, how would we use this 2,000 in our system edge calculation? Like, we calculated average risk per trade, so it is per trade. So if you have to buy a contract, so would we divide it by like
1 minute.
10?
Where is your system edge? 1 minute. Okay, let's open one more file. Hopefully nothing will happen. Yeah, let's open one more file. Okay. Let's have students calc. Let's open the calc. Yeah, so what is your question? Sorry, I'm sorry, I didn't hear that.
One is the average loss that we calculate per trade.
Yeah.
How would we look at this 2,000 in our calculation?
This 2,000, I gave you the example. No? When we were discussing, I said 2,000, how do I come? See, I look at this option.
Where would we put it? Like, should we add it to that average loss per trade, or?
No, it is the average loss per trade. 1 minute. It is how did I come out with a decision? First, through other calculations and taking a view on the eyeballs and underlying, I decided that I want to buy a call. And then with the other calculations, expiration, everything is taken care of. I've taken all those decisions. Now I see that the particular call that I want to buy has a price of $2. Okay. Now the price is showing as $2, but the contract size is 100. So if I buy one option contract, I'll have to pay $200, excluding commissions. Okay, I'll have to pay $200. Then I look at my system risk calculations, and I see that my system risk calculation has given me the average dollar risk per trade, okay, average loss or maximum risk per trade has been given as $2,000, has come out as $2,000. Okay, so that's how I decide, okay, per contract size is 200, price is 200, and my maximum risk per trade is 2,000, so therefore I can only buy 10 contracts. Is this clear? That's how it's being connected.
And it can be done vice versa. Suppose there was an example of 41,000 something.
Yeah, let's.
42,000.
Yeah.
So we calculated suppose we take it as for the stock prices, not as for the currency exchange, because that comes out to be 5 lakh 8 something.
No, those are you're talking about examples, but actually the concepts don't change. Whether you're doing options or you're doing stocks or you're doing cash market equities or you're doing equity options or you're doing spot currencies, the calculation principles don't change. Okay, it's just that in the case of options, you're making a particular assumption which is a little unrealistic. You're making one assumption, which is that every option that is purchased, okay, will expire worthless. Okay, which actually in real life may not turn out to be that way. Some of them you'll be able to sell off by changing your view. Okay, even on the losing trades, you will lose less than the maximum dollar risk per trade. Is this clear? Does it answer your question? What were you asking about spot and all that? Nothing changes. This whole calculation of this system edge and all this stuff is totally based on, we have a few variables, total number of trades, percentage losers, that automatically gives you percentage winners. Then you have an R3 which gives you the average win, and the R3 basically comes, and the average win basically comes into, if you look at it in terms of process, the investor will have some kind of expectation that I want 113% return, and that will give you a dollar amount of profit you need to make, multiplied by the invested capital. You will get the dollar amount of profit that you need to make. From that, using the system edge, you can figure out the because this dollar amount of profit is the same as the system edge times number of trades. So from there you can figure out the system edge, and you have already made assumptions about total number of trades and average loss. Okay, so the only thing unknown is the average win. So from this you can figure out the average win. So then you know that you have to wait. Like if your R3 in this case, where the maximum risk per trade, let's say, is $2,000 in option trading in your system calculations, and let's say your R3 is 7. That means when you have a profitable option trade, you can't take profit on that option trade unless you have made $14,000, because 2,000 is the risk you put on, and your R3 according to your system calculation is 7. So you have to wait before you take profit on a winning option trade. You have to wait until the option value has swollen to $14,000. Is everyone clear about what we are talking? The thinking does not change in any way, whether you're doing spot currency trading or spot equity trading or option trading, because it's all based on assumptions about total number of trades, percentage losers, return on invested capital, okay, maximum risk per trade, those kind of things. It doesn't change anything whether you trade. Yeah.
Multiplied R3 into the average
loss.
If
you see average
win, yes.
No, you don't multiply here. 1 minute. Let's look at this. How do you arrive at average win? You multiply the average loss into the R3, because what is R3? See, in industry people normally say risk reward ratio, okay, but that's actually not correct English use of the language, because if we say risk reward ratio, it automatically implies that risk is in the numerator and the reward is in the denominator. Am I right? Normally when you say risk reward ratio, it would imply that risk is in the numerator and reward is in the denominator. Okay, but actually most of the time people are talking about this R3. That's why I have defined R3 as reward to risk ratio. Now that makes much more sense, because we are putting the average win in the numerator and the average loss in the denominator. So now the language makes more sense. Do you agree? That's why I'm not even talking about risk, reward, the word to is missing. So if I now make it very explicit and I say reward to risk ratio, that is A to B ratio, now clearly A is on top, B is at the bottom. The language is very clear, because that's why every word is important. That's why I keep telling you, you have to talk properly, you have to use the right words, because language is how we communicate. So therefore you have to be very particular about this, right? So is this clear? That's why you're multiplying, okay? Because you have defined the R3 as the reward to risk ratio, okay? Is everyone clear so far? Okay. All right, so let's go back. Now we have understood market risk and this risk. Okay, where was I before? Okay, I was going to this. That's when Shochi's question came. We were going here, right? That's where we were. Okay, so now you can see ET markets, ETM. I'm just going to say ETM and OTCM, because these words are very big. I don't want to keep saying them again and again. Okay, ETM and OTCM. You can see straight away, and you should read that chapter 1 and 2 of Hull also, the parts which I've given, 1.1, 1.2 or whatever. Then those are just stories. It's like stories. It's not really very conceptual, but you get to know what is what. Some of it you can see here also. So here we know that mainly currencies, although they have put, you notice in the case of currencies, I put OTC markets and exchange traded markets, because currency markets trade in both venues, both types of venues. We'll see what they are. First, I'm just giving you a flavor, and then how to relate these concepts to this framework. Okay, so currencies trade in both situations. Okay, usually futures. You notice there's no OTC market under futures, because futures are all basically all exchange traded markets. Okay, now forwards are OTC markets. This is the distinction between futures and forwards. So another way to distinguish between futures and forwards is to understand that forwards are always OTC instruments and futures are always exchange ETM. Okay, so therefore whatever is the distinction between OTC and ETM, in fact I'm not going to say OTCM, I'm just going to say OTC. That will mean OTCM. Okay, so ETM versus OTC, whatever is the difference, that is the difference between futures and forwards. Futures are ETM and forwards are OTC. Okay, so that's another way when we see those instruments, when we see them. So you notice others we have put like in this way, because certain types of swaps are also traded on exchange traded markets, but mainly they are OTC markets. Mainly swap markets are OTC, but I had to put this because certain exchanges do trade swaps. They're not very popular, not very liquid, but they do trade there. So, and options again are both OTC and ETM. Okay, so this is basically what it is. You already understand the framework, so this is how we organize the information. Okay, so some markets trade in both venues. Here you can see, okay, like here these instruments, these are actually OTC FX prices. These are spot FX markets. These are OTC. So let's understand first OTC markets. Everyone is clear so far? We are just giving you some ideas. Now we'll just talk about, let's talk about this. Where is the clock? Yeah, let's first understand OTC markets. Okay, maybe I should make this even smaller to help you to understand OTC markets. Can you guys read the you can see this here. If we make this, now you can see everything, right? The clocks are not important. You can see the bottom, the Pulkit, can you read Los Angeles?
Yes, sir.
You can read it? Okay. You guys can see from there? Others can see? Okay. All right. So this is, let's imagine now there's a bank in each of the centers. Let's first understand OTC markets. Okay. Even better understanding, even more basic understanding of OTC markets is, everyone is familiar with a local grocer who is giving credit. A lot of local grocers sell on credit to the various households in their locality, right? So you pay the bill only at the end of the month, and during the month you keep on requesting him for material. Please send me 2 kilos of sugar, please send me a toothpaste, and so on and so forth. So the guy is basically piling up bills. So he's supplying all the material to you, but he's not getting any money. He will get paid at the end of the month. Now supposing at the end of the month you tell him to get lost, no money. Okay, then he has a materialization of what kind of risk? Market risk or credit risk? Credit risk. Okay. So basically, the point to understand, the reason I wanted to make that distinction between market risk and credit risk at the beginning, before discussing OTCM and ETM, is that in OTC markets, you are faced with both market risk and credit risk. Okay. But in exchange, in the classical form of OTC markets, okay, so some of those distinctions are changing now, but those are very new developments. So we have to understand the classical difference between OTC and ETM. So in OTC markets, you have both market risk and credit risk. Everyone understands this credit risk now. Same concept here. If you see, let's say CBA Sydney, CBA is a Commonwealth Bank of Australia in Sydney, deals with, let's say, Wells Fargo in Los Angeles. Okay, they do a foreign exchange transaction. This is how OTC markets function. Okay, these guys call them up. Sydney night desk of CBA in Sydney deals with Los Angeles in Wells Fargo in Los Angeles. Their treasuries do a deal. Let's say Sydney buys $10 million against the yen for value spot. Okay, they buy $10 million against the yen, so they're obviously, Sydney is buying dollars and selling yen. Okay, now what happens is, on the day, so this is a spot value transaction, so after 2 business days, everyone is following so far, and let's say that the dollar yen trade, the rate is 109.30. okay, so at 109.30 they do this deal. Okay, and so CBA Sydney has bought $10 million and sold yen. Is this clear? Okay, so since they have sold yen, remember, this is a contract to exchange asset. Every transaction in a financial market is a contract to exchange assets. Is this clear? Remember, because the market is a venue for exchanging assets, and so a transaction is a contract to exchange assets. Now, once you enter into a contract to exchange assets, you have to fulfill your obligations under the contract. Eventually you have to deliver whatever you decided to sell, you have to deliver it, and whatever you decided to buy, you have to receive it. Is this clear? Okay, yeah. So CBS Sydney has bought $10 million against the yen, so they are entitled to receive $10 million, and the rate is 109.30. so $10 million into 109.30, whatever is the yen amount, that they have to deliver to Wells Fargo, Los Angeles. Is this clear? These guys will have a yen account. Have you guys done your banking course already? Okay, so there are these things called Nostro accounts and Vostro accounts and all that. You have done it before, Nostro accounts? Okay. Okay. So anyway, Nostro account is nothing. We can just it's just a casual mention that. So Wells Fargo, just like the CBA Sydney, their home currency is Australian dollars, not US dollars. But they need to maintain a US dollar account with somebody in New York. Okay, they will have to maintain a US dollar account with somebody in New York. Okay, so JP Morgan New York, they have, let's say, you can see that they have a, let's say they have a Nostro account. So they will tell Wells Fargo Los Angeles, you pay my dollars to, when you do the transaction, when you do the foreign exchange transaction, you have to also give your instructions. So after they do the deal, they will say my dollars to JPM New York. Okay, so these guys know, and then they'll give the account number. Okay, so these guys in Wells Fargo Los Angeles know which account has to receive that $10 million. Into which account should I pay it for the credit of CBA Sydney? Are you following? They're just maintaining a dollar account, like I maintain a rupee account with HDFC, right? They're just maintaining a dollar account with say JPM New York. This is Sydney's dollar Nostro account. Similarly, Wells Fargo Los Angeles has a yen Nostro account with, let's say, Bank of Tokyo. Okay, so Bank of Tokyo, they will say my yen to Bank of Tokyo, account number 1234. Okay, and so Sydney, 2 days later, Sydney has to ensure that 2 days later, that yen account that these guys mentioned, that account is paid, is credited with the yen amount, $10 million into 109.30, whatever is the yen amount. Are you following the transaction? Very basic, right? You have agreed to exchange assets. Now you have to fulfill your agreement. You have to deliver the asset that you sold. You have to receive the asset that you bought. That's all that is happening. I'm just giving you some of the details of the deal. This is clear? Okay. So now, what happens? Sydney, 2 days later, Sydney makes sure that the money goes to Tokyo, to the yen Nostro of Wells Fargo Los Angeles. Wells Fargo Los Angeles' yen Nostro in Tokyo is credited by CBA Sydney with the yen amount of the trade. Yeah, okay. But since Tokyo time, obviously, as you can see here, Tokyo time is, you can see here, Tokyo has already closed, Sydney has already closed, they will open later. Okay, now New York has not yet opened. Right now only London is open. Okay, alright. So these guys, before they go to bed, their settlements people, the back office people don't work in the night desk. So these guys have already taken care of the payment. 2 days later, okay, when we come to 2 days forward, the Sydney back office of CBA has already taken care of the yen payment. They have made sure that the yen goes to the yen nostro account of Wells Fargo Los Angeles with Bank of Tokyo. Is this clear? They have already taken care of the payment, because you have to send a telex. Please debit our yen account with so and so and pay it to so and so, right? You have to take care of the payment. You have to make sure the payment takes place. So they have already transferred the yen to the yen nostro of Wells Fargo. But when New York opens, New York is still not open. When New York opens, suddenly what happens is Wells Fargo declares bankruptcy. Let's say the US regulator takes the bank into, maybe they have a lot of credit risk problems, bad loan problems. They put that bank into receivership. So let's say it's like a bankruptcy filing. So the US regulators basically force Wells Fargo to declare bankruptcy. So no payments are going to go. Now once you declare bankruptcy, everything stops, okay, because the receiver will now take care of everything, okay, and so he'll not pay out any money. So that payment that Wells Fargo Los Angeles was supposed to make of $10 million into the dollar nostro account of CBA Sydney, that payment is not going to happen. They have paid out their money, but they don't get the money that they were supposed to get. Okay, so this is the problem with OTC markets. This is how they function, and trillions of dollars. You can see in the textbook where they have talked about the size of the OTC derivative markets. I don't know where exactly. Somewhere in the, yeah, he's talking about market size. Look at this. Okay, so he's talking. Look at the difference in the size. Okay. OTC versus exchange traded. OTC is a solid line. Okay.
Some just talking to the system. It's not actually payment or not.
Payment is not happening because CBA Sydney has, their obligation was to pay yen. They've already paid the yen. It's out of their hands. They were supposed to receive dollars from Wells Fargo, but the settlements people who come into office to make that payment to JP Morgan New York for credit of CBA Sydney, those people are not allowed to make payments because the receiver has taken over the bank. The bank has now declared bankruptcy, so the bankruptcy manager, the insolvency manager, will now take care of all the money. Typically the first thing they do is they stop all payments. When you are managing a resolution, so like in India we have the resolution professionals, okay, we're managing the bankruptcy. The first thing the guy will do is stop all payments. No payment. You want to pay me money, fine, but I'm not paying anybody anything. Okay, the first thing they do is that they stop all the payments. So these guys who are supposed to make the payment, take care of the telex instructions, please pay account to so and so, none of that is going to happen because the back office is not going to function for any outward payments. Okay, so therefore this money that they were supposed to receive, they don't receive it because Wells Fargo has declared bankruptcy. Is this clear? Are you following? So this is the fundamental problem of OTC markets, that not only do you have to deal, obviously when CBA Sydney buys dollar yen, if they buy $10 million against the yen, they have market risk because the dollar yen could collapse, go to 106 in a few minutes, and they would lose big money on their position. Okay, but that's market risk. But in addition to that, they also have credit risk, as you can see here, because they paid out, they did their part of the deal, but the other party does not fulfill its contractual obligations because they have declared bankruptcy. And you can see the mismatch of timings. You can see from the way the foreign exchange market works, because all over the world banks are trading, but the back office functions only during office hours. So these poor CBA Sydney guys, they paid, their back office has paid the yen amount, but because New York opens much later, so they don't receive. They thought, okay, at night we'll get the money in the dollar account when New York opens. But New York opens, but the money goes. Means it's sitting with Wells Fargo. It's sitting with Wells Fargo, but under the control of the bankruptcy administrator. It is now with it's not that Wells Fargo has no money to pay. They can pay, but all payments, because of bankruptcy filing, all payments have been stopped. Okay, so you could say it is willingness to pay in some ways. It's a credit risk. Okay, so are you following what is happening? So in OTC, obviously this doesn't happen all the time because you can see the size of the OTC markets. It's a massive market, okay, but thousands and millions of transactions are happening every day. This doesn't happen all the time, but I'm giving you this example to show you that this can happen. This can always happen in any case. Okay, this can happen to any bank because this is the problem of the OTC markets, that you are not basically you are not sorry. The point is, the point I'm trying to illustrate through this transaction is that they have both market risk. In OTC markets, you have both market risk and credit risk. This is clear? And this is how OTC markets function. You have to, this is the best way to think about OTC markets in the graphic. Imagine there's a bank in each of the centers, and all of these guys are connected to each other through telephones, telex machines, Reuters dealing, other kinds of machines. There's a network, there's a communication network. They know how to contact each other. It's not like I don't know what is the number for DBS Singapore. It's not like I know all the numbers. I know the banks in all the centers and I'm dealing with them regularly. Okay, so there's a bank in each center, so they're all connected through some kind of informal or formal communication network. Okay, and that's it, and then they deal with each other, but every time they deal they have this kind of risk. So what just happened in the CBS Sydney versus Wells Fargo Los Angeles transaction, that can happen in every transaction. Theoretically this can happen in every transaction. You could have sent your payment, but the other guy doesn't send his payment, and then you're stuck. You can of course sue them. What will happen is now Wells Fargo will sue. They will file a claim with the administrator of the company, the bankruptcy administrator. They will file a claim that we are owed this $10 million. Now whether they get that money, that is up to the sweet will of the bankruptcy administrator. He will see how many assets he can recover, and based on that, so it's it's like going into litigation. It's a headache. You don't get your payments in the normal course of business. That's the whole point. If you don't get payments in the normal course of business, that's basically credit risk, manifestation of credit. Is this clear? Are you following? That's why we say default company is insolvent when they are not able to pay their debts as they fall due. Okay, of course you sue me in court after 10 years of court litigation, the court orders me, then I have an obligation to pay. That's not called getting money on time. That's why it's not due debts as they fall due. As they fall due in the normal course of business. Is this clear? So has everyone understood that in OTC markets you have both market risk and credit risk? Market risk exists because you buy dollar yen, it could collapse to 106 in a few minutes, you're losing big money, that's market risk. And here, this is credit risk. You were supposed to receive the dollars, you paid out the yen, but you didn't get it, that's credit risk. Can happen everywhere. The point here is that CBS Sydney has no other recourse. When they were dealing with Wells Fargo, they knew that the credit risk of Wells Fargo is completely on them. They can't go running to say NatWest London and say, guys, could you help us? Why don't you pay us some of the money? They can't go anywhere. Okay, so the risk is totally on them. So the credit risk is basically, the idea here is, that's where you come to the first important point in ETM. This note I have shifted into your folder so you can access this file. Okay, now you may not be able to read everything because I want to make sure that everybody can see both the columns, so I'm making it really small in terms of zoom. But this is where we come. This is, now you have understood. We exchange traded I have not covered, but at least this part you have understood, that counterparty credit risk. This is called counterparty credit risk. Credit risk you have already understood. Counterparty is because in this transaction CBS Sydney's counterparty is Wells Fargo Los Angeles, right? That's why we call it counterparty credit risk. Is this clear? Credit risk everybody has understood. Counterparty credit risk. Okay, now so what are we saying here? I'm going back to the framework. Counterpart, yeah.
OTC markets simply means transactions which are done without supervision of SEC or the market regulator. That is what.
That's not necessarily correct, because the market regulator does have sometimes some say in the OTC market. They are less regulated than ETM, but so I would not define it this way. It is very clearly, this is the definition, what I'm positioning on. This is the definition. This is what you should understand in terms of concept, that counterparty credit risk is managed directly by the counterparties themselves. It sounds like a big sentence, okay, it's already there, but you've already understood what it means. I gave you the example. When CBS Sydney does not receive that $10 million from Wells Fargo, they can't go anywhere and say that, oh my God, SEC, can you help us? Maybe some bank controller and bank regulator in California, can you help us? No, they can't go anywhere because they understood that the terms of the contract are such that the counterparty credit risk is managed directly by the counterparties themselves. The two counterparties, CBA Sydney, Wells Fargo LA, they are on the hook. If the other guy defaults, they are on the hook themselves. They can't go anywhere else. Is this clear? So this is the first important property of OTC markets. It operates like a network. Okay, so risk is higher. Obviously on the other side in ETM we are going to write risk is lower. So obviously this property will not exist in ETM. The situation in ETM is going to be something different. Okay, so this is the point, that counterparty credit risk is managed directly by the counterparties themselves. This is exactly what you need to understand. Okay, this file is in your folder. Okay, all right, so where are we? Okay, is this the first? Is this clear? Now let's look at this. Okay, let's look at the corresponding situation in the case of an exchange. What are exchanges? These are some of the exchanges. Okay, CME Group. I don't know why this page is not loading. ICE is an exchange, Intercontinental Exchange. They have changed their name to ICE. Okay, all right. So these are all examples of exchanges. Let's see what happens in the case of an exchange. Who has gone out without closing the door properly? Ritesh. Okay, what are we writing in the case? First, let's understand what we are writing. Okay, guys, is everyone following? Is everyone following? Okay. So we saw that in the case of OTC, so what are we observing about OTC markets? We are observing that, let me just write it here. Market risk plus market risk and credit risk. Is this clear? So it's not looking pretty, but I'm just writing it here. You understand what this means, because the counterparty credit risk is managed by the counterparties themselves. So when you're trading in OTC markets, you have both market risk and credit risk on your head. Is this clear? Now we are going to make this a point of distinction, obviously. And what are we going to write in the OTC markets? In the ETM, what do you think? Which one of them will drop out? Which one do you think will drop out in ETM? Credit risk will drop out. Market risk is always going to remain. Okay, because you have already seen it firsthand. You have been trading options on the US exchanges. You have been trading NSE stocks. You did have market risk, but you did not have credit risk. So the fact that you had market risk, so market risk only. So this is one of the distinctions, obviously, that you have to understand. But it's related to the same point, that counterparty. Now what happens in this is basically that looking at now what happens in between in the case of exchange traded markets. So if you look at an exchange traded market like CME, okay, all the markets that they have, okay, because I have not accepted their they have changed the format of their page. Okay, all the different types of instruments that they trade, all of them will have one feature. Okay, what is that feature? Let's look at maybe I have where is that? There's a brochure actually. I wanted to just look at the brochure. I don't know the brochure. Yeah, I think it should open here. Okay. Read the brochure. Okay. We're going to open it. Now think of this. What would happen is, let's take the same OTC market example and let's transform it a little bit to come to exchange traded markets. Okay, what we are going to do, because counterparty credit risk is being managed directly between the two counterparties, each of them is responsible for the other's loss. They're on the hook for the other guy's loss, any losses from credit risk. Now they decide to put somebody in the middle. Okay, they decide to put a clearinghouse in the middle, whose responsibility is now, instead of having one contract between CBA Sydney and Wells LA, we have two contracts. We put a middleman. We have one contract between the middleman and CBA, and we have one contract between the middleman and Wells LA. Is this clear? We have just split up the same contract. The middleman doesn't really have any say in the contract terms. The contract terms are decided by the two parties. Okay, the middleman is only there to administer the contract and make sure that nobody defaults. Are you following what my statement is? Okay, we are just going to put a middleman in between, and his job is only to administer the contract once it has been established, once the contract has formed. So formation of contract, negotiation between parties, what should be the terms, $10 million, $15 million. Okay, you can go. Your time has come. That sounds like a very prophetic statement. I was wondering for a while why Surbi is getting restless. Yeah. Okay. Yeah, welcome. Okay. So, alright. Are you following now? What are we trying to do? We are just trying to deal with, what? Why? Is it urgent? Okay, go. Okay guys, now let's try and improve the situation in the OTC markets. Let's just try and put a middleman in between whose job is only to administer the contract and ensure that nobody defaults. He has no say in the terms of the contract, whether it should be at a current market rate, okay, or there should be a limit order or something like that. He has no say in that. Once the contract is formed, okay, he will administer the contract. He's standing in the middle. Let's look at the CME. Why is the brochure not opening? Right. Okay, good. Let's look at it this way. Now, imagine you forget all these other people. Just look at the OTC customer and the OTC dealer, okay? And forget everybody else. And then you have this clearing, CME clearing in the middle. Now we are talking about exchanges, okay? So these guys, this guy doesn't exist, this guy doesn't exist, this guy doesn't exist. For the moment, just understand this. This guy exists, the CME clearing house. You have the dealer and you have the customer. Okay. Now let's assume that CBA Sydney is the customer and Wells LA is the dealer. Okay. And you have the clearing house. So earlier they were dealing only between themselves. This orange part, OTC markets. Okay. And now they are going to go. Once they form the contract. Okay, they submit the contract, let's assume, actually, basically they deal on the exchange itself. So you have two contracts, one between this guy and this guy, one between this guy and this guy. Is this clear? You have two contracts. Okay? 1 minute. Okay. What did we say here? That CBA Sydney buys $10 million against the yen at 109.30 on value spot from Wells LA. Okay, so Wells LA is selling yen amount at 109.30, yen equivalent of $10 million at 109.30. Value is spot, so 2 business days later. Okay, so now 2 business days later, CBA Sydney, we'll just call it Sydney. Sydney fulfills its obligation under the contract and delivers the yen. But LA does not deliver its obligation, does not perform its obligations. Okay, so now Sydney has a problem. To avoid this problem, we are setting up an administrator of the contract in between after the formation of the contract, who has no say in the terms of the contract. What rate, what amount, what market. He is not involved with all that. He is only involved with the administration, the proper administration of the contract, and to ensure that contract is executed faithfully by both parties. That both parties discharge their obligations. So use the legal language to ensure that both parties discharge their obligations under the contract. Is this clear? Everyone is following? All we are trying to avoid is that situation. So we have set up this CME clearinghouse in the middle. So now we are going to have 2 contracts. Now what is going to happen? Sydney is going to buy dollars against yen at 109.30. One contract between Sydney buying dollars at 109.30 from the clearinghouse. We'll call it CME to use short words. We're going to call the CME clearinghouse CME. So now Sydney is buying 109.30, $10 million against the yen from CME. Okay. Now in turn CME is buying $10 million against the yen at 109.30 from LA. Is this clear?
So CME is taking
1 minute.
and giving it to Sydney.
Yeah. Basically that's what they're doing. Yeah. They are just putting themselves in the middle, but there are 2 contracts. The point is, earlier there was only one contract. Earlier there was only one contract between the two parties themselves directly. Is this clear? Earlier there was an OTC markets, there was only two. Now what we are trying to do is we are trying to understand ETM by suggesting some modifications to OTC. That's what I'm just teaching you the concept in that way. How do we get to ETM? It's as if we are trying to get to ETM by introducing some modifications to OTC. Is this clear? That's how I'm just introducing the concept to you. Okay? So that you can see the advantages on the credit risk side. Is this clear? So there are two contracts now. Earlier there was one contract. Sydney buys $10 million at 109.30 from against the yen from LA. Now there are two contracts. Sydney buys 109.30 $10 million from CME. CME buys $10 million against the yen 109, same terms. CME buys $10 million from LA. Now there are two contracts. Okay. Now this guy will ensure that nobody defaults. Is this clear? Are you following, everybody? First,
this middleman comes after the contract has been signed.
yeah, but in fact what happens is you are trading on the exchange. So whether he comes after or before doesn't matter, but the deal is that he can't interfere in the terms of the contract.
Now he has received delivery.
His job is only to ensure that everybody discharge their obligations under the contract after it's formed.
What do we call it? What is the right name?
Clearinghouse. It's a clearinghouse. Okay. ETM. Now we are talking about ETM, right? So it's an exchange clearinghouse. See, that's why they call it CME clearing. Can you see that? CME clearing. So like in India, every exchange needs to have its own exchange, own clearinghouse. Okay. In the US, it's not like that. As long as you're affiliated to a clearinghouse which is approved, it's fine. Okay. But this is CME clearing. Okay. But I'm not going to use CME. I'm just going to call it CME because it's a shorter word. Okay. Is everyone clear so far? Two contracts. Okay. Now the objective of this clearinghouse is to ensure that nobody defaults, or even if they default. Okay, basically what happens is that obviously that credit risk amount that has already been paid, the yen amount that's already been paid, they can't do anything about it. But if they default, whatever the replacement of the contract is, the replacement of the contract can be done without any loss. We'll see how it works immediately. But basically the objective of the clearinghouse to ensure that nobody defaults. And how do they ensure that? Okay, let's assume that if you see here, alright, mark to market you already understand. See, this is already this is still I have to make it 75%, otherwise you can't see everything. Yeah, there is no daily mark to market. Profit and loss is settled only or realized only at maturity. What does that mean? It only means this. It means that if you are doing a transaction, let's say if we have dollar forwards. Okay. So this shows you again very I don't know if you can see, but that you can see that forward dollar exchange rates, forward differences for dollar for currency markets are being quoted all the way up to 1 year. So if I do a 1 year deal, remember settlement date can be different from transaction date. Okay, so if I have bought, let's say I am Sydney, I bought $10 million at, let's assume this transaction is not spot, but it is forward. Okay, and let's assume for the sake of argument that we simplify it and we assume that spot and forward rates are the same. So this is a forward transaction. So settlement date is 1 year, and it's a 1 year forward transaction. So settlement date is 1 year from today. Okay, 1 year actually, and 1 year and 2 business days. Because spot is 2 business days from today. So 1 year will be 1 year ahead of spot. Okay, so 1 year, let's say we just call it 1 year. So now I have bought $10 million at 109.30. Okay, now I have bought $10 million at 109.30. Now what will happen is that, now what can happen is, let's say in this case say Sydney has bought 109.30 $10 million. LA is a seller of dollars at 109.30 against the yen. Now it's a 1 year transaction, so a lot of stuff can happen in 1 year. Let's say after 1 year, near the end of the maturity of the contract, the dollar yen is, let's say, at 104. Okay, so who's losing money under this contract? The one who's buying, which is Sydney. So Sydney is losing big money on this contract. So Sydney has an incentive to default. You have to see who has the incentive all the time. Sydney has an incentive to default because they are losing big money on the contract. Okay. Now, if Sydney defaults, who is on the hook? LA is on the hook because LA thought they were making big money by selling dollar yen at 109.30 and seeing it drop all the way to 104. So LA thought, wow, I'm sitting on big money. Okay. But now suddenly they get bad news because the other guy decides not to honor the contract. This is what happens a lot in commercial transactions. Whenever there is a party sitting on a loss, he will decide, get lost. He will tell the other guy, get lost. Okay.
Clearing house will be called to honor the obligation.
Yeah, no, you're coming to that. You have already come to the point, but now we'll talk about it. Okay. So now we have seen the 1 year scenario that in 1 year's time it drops from 109.30 to 104. Okay. This is clear, everyone? Okay. Now what is the job of the clearing? So the point is that now if after 1 year when there is a default, okay, these guys were basically making this 109.30 profit, okay, profit between 109.30 and 104 on $10 million. That profit was being made on the mark-to-market profit was there in LA's books. LA was sitting on that mark-to-market profit. Now you understand mark-to-market, okay? But suddenly that profit disappears because the other guy says get lost. Okay, so there should be the correct way to handle this is to make sure that LA gets this profit anyway. Right? If we can make sure that LA gets this profit, then everything is okay. Nobody's unhappy. Is that okay? They were sitting on a profit of 109.30 minus 104 times $10 million. Okay. If we can somehow make them give this profit, then there's no problem. If we can somehow make them get this profit, then there's no problem. Right? Is that okay? Yeah. So that's what the clearinghouse does. Now assume that this did not happen over 1 day. This happens over one night. Overnight movement. Let's assume. Okay. Now how does the exchange clearinghouse deal with it? Because the exchange, see, if now we have two contracts. So this is Sydney. Sydney is defaulting with Sydney is the one who's defaulting because they were losing money big time. Okay. Now Wells Fargo, what have Wells Fargo done? They have sold dollars at 109.30 to the clearinghouse. Now the clearinghouse can't. They have bought those dollars from. They have this. LA has sold dollars. Clearinghouse has bought dollars. Okay, and so therefore clearinghouse still has to honor its contract with LA. Okay, because these are two different contracts. Because these guys who have bought dollars from CME, they are defaulting. The party who's defaulting is Sydney because they bought dollars at a high price and it dropped in value. But the problem with the clearinghouse is the clearinghouse, just because these guys have defaulted, they cannot tell Wells Fargo to get lost. They can't tell LA to get lost because they have a separate contractual obligation with LA. Okay, so what does the clearinghouse do essentially? Okay, let's look at this. What is the clearinghouse going to do? Let's assume that this movement can happen overnight. 109, I want to take big movements so that we get an idea. 109.30 to 104. Okay, this movement happens overnight. Okay, and this contract is still for 1 year. Okay, it's a long contract. The clearinghouse, when it enters into these two contracts, already makes clear to the parties that I am going to collect daily losses from you and I'm going to pay daily profits to you. That's the only way they can save themselves. So when the clearinghouse buys at 109.30 to honor its contract with LA, the clearinghouse has to buy dollar yen at 109.30 when the market price is 104. So the clearinghouse is losing all that money because it has to buy the dollars from the market at 104. Okay, it will buy from LA at 109.30 and it will sell in the market at 104. So it will suffer this loss. So it will ensure that its systems are such that it will make up this loss from Sydney. So what does the clearinghouse do when you enter into a contract with the clearinghouse on an exchange, which is all for ETM contracts? All ETM contracts will be with the clearinghouse. And what does the clearinghouse do? The clearinghouse makes it clear that every day you will have to make up your losses and every day you are entitled to take away your profits. So let's assume that this movement between 109.30, I'm going to exceed a little bit, okay, the time. Yeah, it's exactly time now. I'm going to exceed a little bit. Okay, so you'll have to bear with me on that. Okay, so every day the clearinghouse, please make sure you understand. Okay, is it better? Isn't it better if I go from OTC to in step by by just making improvements to OTC? We are getting to the exchange traded scenario. Is okay? You understand? So the clearinghouse arrangement is always like this, that it tells you very clearly that every day you will have to pay up your losses and every day you will receive your profits. So assume now that this 109.30 to 104 movement happens in the contract is made that Sydney buys from CME 109.30 $10 million and CME buys from LA 109.30 $10 million, and after one night itself the dollar yen rate drops to 104. So there is now a massive loss on $10 million, 109.30 to 104. Sydney is facing this loss. So the terms of the contract already are that these guys have to immediately pay the loss the next day. So next morning, when we will see, then the morning if you enter into a contract on the exchange, okay, by night time when the exchange closes, there is a closing price. So the exchange will see how much money you are losing according to the closing price and your entry price. And the clearinghouse will ask you to pay up by 11 a.m. next morning. If you don't pay up, they will close out your position. Okay? Are you following? Yes. So let's say that the Sydney people tell the exchange that tell CME, get lost, I'm not paying you. Now, before they were able to enter into that contract on the exchange itself, the clearinghouse took a deposit. They without paying a deposit to the exchange clearinghouse, okay, you cannot trade on an exchange. So the deposit is already sufficiently big. The deposit is already sufficiently big. You will see that there are contracts have margins. Each contract has a margin requirement. Okay, so the deposit is already sufficiently big. So after one night, okay, after one night, there is a massive loss on the dollar yen position. CBA Sydney is showing a massive loss. The exchange tells CBA, you guys have to pay up this amount of loss. Last night you lost this amount of money. You have to pay up immediately by 11 a.m. this morning. Otherwise, we'll close out your position in the market. Okay?
So if there is a profit, massive profit.
We're coming to the profit. We'll come to the profit. All the other side is already showing a profit. LA is showing a profit. Sydney is facing a loss. Okay? Sydney is facing a loss, so LA is showing the same profit. We'll come to that later. First, take care of the loss. Okay? So now Sydney decides, even if Sydney says that get lost, I'm not even paying you for tonight's loss, for last night's loss. But they have already had to put a huge deposit with the clearinghouse to be able to trade on the exchange. To be able to enter into the trade itself, they had to pay a huge deposit, which is a good faith deposit you have to put up to even enter into the trade. So what the clearinghouse will do is fine, okay, suppose the loss here is equal to $3 million. Let's say the loss is $3 million, okay? Now we are talking about $3 million loss. This guy says that overnight loss of $3 million, I'm not going to pay up. But the deposit they would have taken was already big enough, like 5 million or something. Initially you have to already put up 5 million. So then CME will say, fine, we'll forfeit your deposit and we will use 3 million from there to buy the dollars in the market and to sell the dollars in the market after buying it from LA. I fulfill my obligations with LA, I buy the dollars and I have to sell it immediately in the market, and the market price, I realize a loss of 3 million. I will use that 5 million deposit that you gave me, I will fund that loss from the 3 million loss from that 5 million deposit you gave me. Is this clear? No, that you will have to look at the contract, but normally if you were not paid up, they may actually forfeit the balance.
But if
you may forfeit,
But if the transaction is not to sell it,
then the exchange is on the hook for the balance. But normally what they do is they look at the market volatilities and they make sure that your margin is sufficient. Because next morning at 11 o'clock they will close out your position if you don't pay. If you don't pay your losses from the previous night, they will close it out by 11 a.m. next morning. How much movement can happen between one previous day and 11 a.m. next morning? They have enough money. They take a sufficient margin. But you're right, you can always miscalculate, but generally they conservatively calculate a very sufficient margin so that they are never left out on the hook like that.
And 3 million is only the profit or the transaction amount?
No, I'm talking about the loss. I'm talking about the loss. Let's assume we have not calculated what the actual loss is on 10 million, 109.30 to 104. Okay. To save ourselves the calculation, we are assuming that on $10 million between 109.30 and 104, the total loss is $3 million. The mark-to-market loss is $3 million.
So you are talking.
I'm just assuming. It's not correct. It is not correct. I'm saying it's a loss. Yeah, I'm talking about not the transaction side. Transaction side is $10 million.
So sir, where will the $10 million go?
$10 million we are not concerned with. No, because see, look at what happens. Look at what happens. CME, just bear with us. Let's at least understand this concept clearly. CME has two contracts. One fellow on one side of the contract is acting funny. He doesn't want to honor his contract. Okay, but I have a system for him. He has given me deposit, which he's not going to get back. Okay, I will use his deposit to fund the loss. Okay, he has a $5 million deposit with me. He's not getting it back, and to take care of his default, I will face a loss of $3 million in the market. I will use that $3 million out of that $5 million to fund the loss. Is this clear? $10 million I'm not concerned with, because it could have been $300 million also, contract size. Because I am buying 300 million or 10 million from LA under my contract with them. Immediately I'm squaring off that $10 million in the market by selling it off at 104. I'm realizing a loss of 3 million, which loss I will adjust against the deposit left to me by Sydney of 5 million. Is this clear? So I have no problem. I'm not really concerned about whether it's 10 million or 300 million, as long as the market can handle that kind of transaction. This is clear? Okay. So now you see, so what does the exchange clearinghouse do? This is the term, these are the terms of the contract. Before you trade on an exchange, every exchange is connected to a clearinghouse. Okay. All your transactions, essentially you have two contracts. Okay. The clearinghouse is entering into two separate contracts instead of just having one contract between the parties themselves in the market. And this is how an exchange clearinghouse is able to manage the credit risk, because every day it's collecting losses. And on the other side, so suppose that this guy had honored the contract. If this guy had honored the contract, okay, then what happens? This guy has to pay a $3 million loss. Last night's loss is $3 million. He pays up. Then the exchange releases the full $3 million to LA. They can go and party with that $3 million. It's their money now. But then tomorrow, next morning, if LA is facing a loss, because remember, next morning's calculation is not from 109.30, because now the rate has already been set at 104. So next morning, if the rate is next night's settlement price, if it is 105.30, now LA is facing a loss, because after the settlement of today's P&L, LA is now short dollars at 104. Are you following?
Yes, sir.
LA is now short at 104, because 109 to 104 they have already been adjusted and paid. Now you're short at 104. Now the next day's settlement price is 105.30. Now LA is losing money. Now LA has to pay this money, otherwise their contract will be squared off in the market next morning at 11 a.m. Is this clear? Okay. All right. So what have we covered now? So this is basically what happens. This is an exchange traded market, although I've given you a clear port example, which is a hybrid example, but forget about the hybrid part. This is what happens. On any exchange, when you enter into a contract, there is a clearinghouse in between. Okay. Party 1, Party 2, clearinghouse. There are two contracts, each party contracting with the clearinghouse. And the clearinghouse essentially ensures that there is no default, or even if there's a default, nobody really loses any money, because the clearinghouse honors its contract with the other guy. And how do they make up? If they have a loss on honoring the contract, they had a loss of 3 million by honoring the contract with LA. Well, they made it up from the deposit given by the initial counterparty, the defaulting counterparty. Both counterparties have to put up deposit. Is this clear?
Yes.
Okay, so they made it up, and therefore they do not have a problem. So the deal is basically you've got to put up an initial margin. This deposit is called, you can read about it in the book, okay, in your textbook, those readings which I've given you. The deposit is called initial margin. Okay, for any exchange traded contract you need to put up some initial margin, otherwise you don't get to do the deal. Okay, that initial margin is what we have called 5 million in this example. So any given day, if you don't pay up your losses by 11 a.m. next morning, now 11 could be 10:30 or whatever, okay, early in the morning, If you don't pay up, they'll square out your position in the market. They'll cancel your trade and square out your position in the market, and they will not face a loss. They will adjust it against your initial margin. Is this clear? Okay. And so that's how, so every day's loss is taken care of, and that's how the credit risk is managed in an exchange traded market setting. Is this clear? Okay. So that's why you have this statement in your framework. Counterparty, now you understand what is meant by counterparty. You understand both the statements. Make sure. Now you see counterparty credit risk managed by exchange. By exchange means by exchange clearing house. Okay. I'm equating the exchange with the exchange clearing house. Is this clear now? Are you following, Pulkit? And you understand the next that statement also. Daily mark to market settling profit loss daily. Now you understand what this means?
That means the accounts are pretty daily.
Every day you have to settle your losses, and every day you get to take home your profits. Is this clear? What this statement means? So you already have access to this framework. Yeah. So this is basically the most important difference. Okay, this is the most important difference between exchange traded markets and OTC markets. Okay. Another example is, I'll just briefly cover it, which is very simple. That if you the difference is that in exchange traded markets everything is standardized. If you look at a futures contract, if I look at energy, if I go to a, remember we looked at the oil futures contract terms of reference. If you look at the contract specs, we looked at the where are the contract specs? Oh, I haven't even gone into oil futures. Oil futures trade for 1,000 barrels. CME oil futures, look at this here. Contract unit 1,000 barrels. When you are trading on an exchange, you have to trade in integer multiples of contract size. Just like your option contracts you're trading, every contract is 100 shares. So the price is 1.56, means actually you have to pay 1.56 into 100 for each contract, right? Because the standard contract size. You can't go to the CME oil futures pit and say, I want to buy 674 barrels. You can't say that. Everything is standardized, okay? Because it's an exchange, so that's one of the things they need to do. So this is the second important point, basically, that you have standardized OTC markets. You can do whatever you want. You can go to Trafigura, which is one of the biggest oil traders, and you can tell them, I want to buy 675 barrels of oil. They will do it for you. That is the main advantage of OTC contracts. OTC contracts are, like you saw, between the two counterparties, they can decide the terms of contract. Okay, there's no need for standardization. You can get odd dates. If you look at this futures, if you look at this forward price, these are 1 month, 2 months, 3 months, 4 months, 6 months. These are actually, you can actually go to an OTC, these are OTC products, foreign exchange forwards. You can go to a bank, let's say ICI PLC can go to Standard Chartered Bank in London and say, I want a foreign exchange forward contract for 1 month and 7 days. That's an odd date. You don't have to have round amounts. You can take any settlement date you want. You can take any amount you want. Okay, all customization, full customization, OTC markets. Because you could technically say, why should anybody trade like this anyway? Why should I take the credit risk? Why should I not just trade on an exchange and not have to deal with the credit risk? Why should I even bother to trade like this? You could say that. Well, the only reason you bother to do that, the main reason you bother to do that is this stuff. Customized contract terms, which have the great value in business. Is this clear? Alright, so there are some other differences which we don't need to worry about. We are basically concerned with only two things. Highly standardized, you should check out some of these contract terms to see how highly it is standardized. Okay, the termination of trading, settlement prices, settlement procedures, what kind of crude oil can be delivered. You can't take crude oil from Saudi Arabia and deliver into this contract because it's not covered. Okay, so everything is specified. Okay, highly constrained. Everything is specified, highly constrained, no flexibility. Yeah. Oh, you have another class?
Yes, sir.
Oh my God. Okay. Sorry. I'm so sorry. Oh, it's already 3:15. Your teacher must have come. Okay, guys. So we have understood two important differences. Is that clear?
Yes.
Two important differences. Okay. No time for questions now. Okay.